What is going on, everybody? My name is Matthew, and today I'm telling you exactly my strategy for buying during a stock market dip, correction, crash, whatever you want to call it. Let's be real, this is not a stock market crash. Go look at the S&P 500. It's up 3% still for the month of February. This is more of a correction and seeing stocks coming back to normal valuations, but let's get right into it. So we're wasting no time. I'm just going to tell you the strategy. Always have a plan before anything even happens. What I mean by this is I think the best thing to do is have a list of different stocks that you are looking to buy given a correction. And that for me is what I call the valuation issues list. I literally have a list of stocks that I really like as businesses and companies, but they're just too expensive for me to justify buying in with a good risk reward. And when something like today happens where we see a lot of tech fall really hard, a lot of those stocks on my list are going to start becoming more and more attractive. Now for this list, I recommend you have some sort of way to value your companies and you have a target price in mind for when you would consider buying these stocks. This is probably one of the best ways to eliminate emotion and prevent yourself from making mistakes, emotional decisions, rash choices, because if you make this list and these price targets before anything even happens, when the market is kind of normal, that's probably when you're thinking the most clearly. I would also have a list of stocks you think are already attractive before the correction, crash, or dip, because as they go lower, they're only going to get more attractive, except they're really attractive now. For example, I alerted my top tier patrons today of buying the dip on Zora, ticker ZUO, because I thought this stock was already attractive before the correction, and now it's even more attractive, and I think the risk reward has just gotten better. And this right here is when conviction comes into play, and you really have to know what you own and what you have bought, because I think if there is a correction or a crash or something like that, you first have to ask yourself, what is the cause for that, and does it affect the fundamentals of the stock that I'm looking to buy? If not, then it might be a good idea to add to that position or maybe even start a new one. Now, at the same time, I don't recommend buying a stock just because it's red or down a lot, because that might be the market kind of telling you that, hey, this was really overextended or really overvalued. And again, this is probably where that conviction, that research, and your valuation should come into play. There are some stocks that I own that I really love, but I think they're too expensive for me to keep buying at these positions. It doesn't mean that they're not going to keep going up. It just means that I probably won't be averaging up even after a drop like this. Because if you do average up every time there's a dip on a stock that might actually be overvalued, then your cost basis will slowly increase. And then say one day the valuation actually kicks in and the market says, no, we're changing our minds, let's go back to reality. Your cost basis is now way up here and the stock could be falling further than that. Now there's actually a second part that I have to check my boxes on before I make any moves on a red day, dip, crash, or correction. And when you combine this with what I just talked about fundamentals, valuation, target prices, planning ahead, and you combine it with what I'm about to talk about, then you're probably going to make some really good decisions. And of course, I'm talking about technical analysis. Now, don't get me wrong, I'm not a day trader, swing trader, or any kind of short-term trader. I'm first and foremost a long-term investor. Now, I know there's mixed results or mixed reviews on TA amongst the long-term investing community, but personally, I think it is very important in building conviction of when you buy in times like this where there might be some uncertainty. I think it's very important in showing you where is a smart place to add to a position or maybe even start a position. And the best part is that if you're using technical analysis for long-term investing, you really don't have to have all of these fancy indicators. I think you really just need to keep it simple. I'll show you what I mean. And if you've found any value in this video so far, if you could just hit that like button for me, I would really appreciate that. We can get this out to more people. All right, let's spend about a minute talking about how long-term investors can successfully buy the dip with a little help from technical analysis. So this right here is a chart showing 6 months worth of time for Upwork, ticker UPWK, and each candle here represents 1 day. So as you can see, I zoom in and I drew some support based on connecting some of these candles, a basic support line. And guess what? It actually came down and touched it before moving back up. And as you get more experience and you learn more about technical analysis, you'll have this happen where it seems like it's crazy, but your lines and your support lines and trend lines, they actually work. And you can also see this moving average coming up to potentially support Upwork at this price as well. And if I zoom back out, every time it's gotten near this moving average, it has bounced a little bit. So right here, it could look like a good place to add. But does it check out with the fundamentals still intact? Is the valuation still attractive? If those two are true and the TA looks good, I might have to nibble and buy some shares on this dip. In this case, I didn't because Upwork had earnings, which kind of made it more risky, but they crushed it, so let's move on. If that was intimidating, don't be intimidated. Just keep it simple if you're a long-term investor and look up some tutorials on YouTube for technical analysis. But of course, I want to emphasize again, fundamentals come first. All right, now for some hidden gems. And again, if you're liking this style of video, I'm thinking of doing these maybe on a second channel because usually my videos have a lot of special effects, high production value, but I feel like I have a lot to say on day to day. So if you like a video like this, go ahead and let me know in the comments. Maybe I'll start a second channel, or we can even keep these on the main channel if we get enough of those thumbs up. All right, so the gems or the lessons to take away from a day like this. 1, buy intentionally. Make sure you're not just buying again because it's red, but because you have solid reasoning to do so, and respect your money and it will respect you back. 2nd, don't get emotional. If you feel like you're getting emotional and you are a long-term investor and you've invested in strong, good, fundamentally sound companies, it might even be worth it just turning off your phone or whatever you're using to watch the market, go outside and take a walk and let the market close and then reassess and make another game plan. 3rd, and I know a lot of people in the Discord learned this lesson and I'm so glad everyone reflected on today, always have cash. As long as you have cash, you have power. You have the ability to take advantage of these opportunities. Personally, I don't try and time the market by trimming or selling positions. I time the market by changing the percentage of cash I hold in my portfolio. Now, recently, I've been letting the cash build and build and build because we've had pretty much straight up for the last few weeks. Then a day like this comes and I'll try and start buying in a disciplined manner. I probably won't go all in at once because you'll never know how long these things can last, but sometimes you'll see me in the Discord posting 4 or 5 messages on red day saying I bought all of these different positions because I guess the way you could look at it is like lying in wait for these deals and these days, and where it makes sense to just kind of snipe these stocks one by one and grab them where it counts. That was a really weird way to say that, but you know what I mean. And lastly, remember that stocks fall faster than they rise. And what do I mean by that? So if you have a $100 stock and it rises 20%, it's now at $120. That's a $20 jump. But then if it falls the same amount, 20%, the dollar number is actually different. It's going to fall to $96. Not only is that a $24 drop instead of that $20 jump, but you're actually now at $96 below where you started at $100. So despite that same change in percentage, you actually move much faster on the way down because you're starting with a bigger number. I hope this kind of video was helpful. Please do let me know in the comments if you like this style where I'm kind of just talking to the camera, showing you guys some stuff on my screen, because usually I go super in-depth on research, but for a video like this, there's not much research to do. It's just me trying to provide some value. So if you found this just as useful, please let me know. That'd be super helpful for me to learn, and I might even start a second channel there as it says on the whiteboard. But if this gets enough love, maybe we can keep them on the main channel and just keep everything in one place. So any feedback, good or bad, is highly appreciated. That's how we always get better. Make sure to hit that like button, subscribe, and check me out on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And also check me out on Clubhouse. I'm just new to there. I want to start learning more about this platform, so feel free to add me there. If you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.